Good morning and welcome. I am here to talk about the one big, beautiful bill once again. Today we are going to talk about part two, which impacts individuals and what changes have been made that will impact tax planning and taxes going forward this year and into the future. So, for those who don't know me, my name is Beth Whitworth. I am a CPA who was born and raised and still lives in St. Louis, Missouri. We are, I've been doing accounting for a very long time and have been a tax preparer for 29 years. And this year is the biggest legislation we have had since the pandemic. And prior to the pandemic, the biggest legislation was the Tax Cuts and Job Act in 2017, which was a huge, huge bill that changed that had been the biggest change since 1986. What the new bill today that we're talking about, it is taking what we did inside of the TCJA Act and making sure that a lot of those things that were hanging out there that were set to expire at the end of this year are addressed. So, for those of you who are watching on Facebook or LinkedIn or YouTube, feel free to comment at any time. Put something in the chat or comment if you have any questions or if there's something that you would like to learn more about, or even just comment and let me know you're here. I would love that as well. We are broadcasting live on Facebook, LinkedIn, and YouTube. So I'm welcome. So I will tell you that this is a huge amount of information, and I am going to do more of a high level type of review of these things. There are going to be some that will deserve a whole lot more time and probably be very specific to some people as far as um, maybe that you might have to get specific with your tax preparer on them. But I'm going to do a highlight of things that are new, things that are maybe have been made permanent from the TCJA bill, and then also just things that you need to consider and think about. So um, let's hold on one second. Technical difficulties. What is happening here? It doesn't like Facebook right now. So, not sure. It says they're having trouble technical difficulty on Facebook. So if you're watching on Facebook, I'm sorry. Let's see. We can maybe hop over to YouTube or LinkedIn, and that's where I would be. Yeah, so this appears to be a streaming issue. Not, hold on, let me look just real quick. Am I there? No, it still shows my timer over there. Okay, so I'll have Becky, who's here, maybe troubleshoot that a little bit, but we will go ahead and get started because, like I said, there's a ton of information. So, if you are looking for information about this big, beautiful bill, there, here is the link that is the to the actual text. It is hundreds and hundreds of pages, but I will caution you that as you are getting information about what has changed, what is new, make sure you're going to reputable sources. Make sure you are talking with people who are actually in the industry. Um, all the guidance is not out yet. So there is some speculation on how some things are going to be handled, and it's very easy for some people to jump in and make something sound like it's too good to be true. If you've listened to me before, you know that if I say that you think something sounds like it's too good to be true and it has anything to do with the IRS, it is probably too good to be true. So let's get started. So reputable sources, our main sources are AICPA, Journal of Accountancy, irs.gov website. Right now, there's not a whole lot other than news articles and CPA firms and people putting information out, which is great. I would say stick with those firms that are big enough to have their own research departments. And if you're looking up information, do not rely just on good old chat GPT or Claude or any of those. All of those need to be fact checked. And I tested that as I was preparing for some of these sessions. And sure enough, things that are clearly stated in the law for limits or amounts, they had wrong. So I schooled them. I said, "Hey, don't you think that's really this amount?" "Oh, yes, you're right. Good catch." So careful there when it comes to using AI to really get your knowledge of this bill, because there's everything about it is really out since the bill passed in early July. Okay, so we're going to first talk about what was made permanent. Now, like I said, the TCJA Act was a huge bill that made huge changes to individual tax returns. That being, for the first time in decades, it uh, eliminated the personal exemption that you used to get. So the people that had a huge family got, thousands and thousands of dollars that they took off their taxes. It eliminated that, and it replaced it with a standard deduction that was much higher. So instead of a $6,000 limit for a single person, it was 12,000. For a married couple, instead of 12,000, it was 24,000. And so that got people to have a higher standard deduction. Um, and it got fewer people needing to itemize deductions. So the difference between that is, if you use the standard deduction, if you don't have enough of certain expenditures and things on your return that would actually be um, go over that standard deduction amount. So it was super easy to get over $6,000 or $12,000 when you were married filing jointly back before 2017. But now it's a lot harder. And it has, that standard deduction has um, continued to increase for inflation. And so now it's, $30,000 for a married couple or higher. So that has been made permanent. No more personal exemptions. They're not coming back. And the standard deduction is still high, which is it's good and bad. For a lot of people, it was a huge tax benefit because they weren't anywhere close to being able to itemize. And getting this large standard deduction really did reduce their taxes. Now, so that has been made permanent, as well as the tax rates. And I will say this with the caveat that, tax rates are always subject to change. Even if it says that the rates from the TCJA Act have been made permanent, that is permanent until there's another uh, decision to change them by Congress. So, but what it was set to is that after 2025, the rates were going to revert back to TCJA times, and now they're going to hold steady. And those rates are between 10% as the lowest bracket to 37%. And so those are not going higher at this point, and they're also going to add a couple of inflationary steps in the lower brackets, meaning that the bracket, so I don't even know off the top of my head what the brackets are as far as the dollar amounts, but it's going to add some upper limit so that that you'll stay in that 10% bracket maybe longer, or 12% bracket longer. They're not going to do that for all the brackets, but they are going to do that for the 10 to 12%. So rates were made permanent, standard deduction was made permanent, personal exemptions being out was made permanent. The child tax credit, that we saw a whole bunch of things happening in and around the child tax credit during 21, 22, all of those pandemic years. They have made a permanent increase to the child tax credit is $2,200 with a $1,400 refundable portion. So you don't get all $2,200 as refundable if but you can use that $2,200 as a credit, which reduces your tax liability. The other piece of the child tax credit that's related is the other. So they lump into this other category. It's an other dependent credit, and that is for once your kid's over 16, they're still in school, you're still going to get $500 for them. So they don't fall off completely. You get the $2,200 per child up till 16. You get $500 for anybody who is your dependent, including a parent. So if you are starting to claim your parent, you're supporting them, they live with you, you can get $500 for that person as well. So that has been made permanent. That was new. When they put in the child tax credit, they put that caveat of being over once they hit 16, they fell off that. And so they kind of picked it up by putting this um, $500 out there for your college age students, your older high school students, those types of things. So all of those things have been made permanent, and that's exciting. I think the tax rates that was a huge what we call a tax cliff, where okay, we're planning. We get to 2025. Here's the rates. What are they going to be in 2026? We don't know, and that makes planning very, very difficult at that point. So now that we know, we can better plan. So let's see, what else do we want to talk about? The other things made permanent or relating to your mortgage interest. So I don't know, you may or may not have been aware that in TCJA made essentially acquisition indebtedness, meaning you purchased a home, you were limited to $750,000 that you could have as the amount that could be considered the interest on that amount is how much you could have for mortgage interest if you're itemizing. They have made that permanent, and they have also made, and this is one that I think impacts more people, the home equity line of credit. So they used to be able to, if you had something that was considered home equity, the interest was deductible. TCJA put in place the rules that that home equity line that you take has to be used for your home. So when people were using home equity lines to refinance credit card debt or to pull money out to help send their kid to college or, to invest in some other property, those were not considered reasons that you could get that home equity interest as part of your deductible mortgage interest on your Schedule A. So that is still a thing. So just beware that I know that there have been people, in the past for years, you refinance your house, you pay off some debt, maybe you put a roof on, but most of it went to kind of get that lower interest rate. Now, interest rates right now on home equity they're pretty high, although not crazy. I don't think they're even higher than when, we refinanced at some point and got it down to 6% because it had been that high. So just keep in mind that home equity lines of credit are have some limitations. And then finally, the other big piece that was made permanent that we for honestly didn't want to see come back because it was so big. It was the section on the unreimbursed employee business expenses. It was a part of your itemized deduction schedule, and it was a huge tax planning deal for anyone who got a W 2, but really kind of ran their own office, or they were a single owner S corporation. We were able to use these itemized deductions for their vehicles and their mileage and their meals and their entertainment and their um, just all the things, marketing, everything. And that was for some giant companies, that was how they ran their business. So they paid everybody by a W 2 and then said, you're going to pay this stuff out of pocket, for your business, and you're going to take this on your as an itemized deduction on your personal return. That vanished in the 2017 filing season and became a huge deal for some of these organizations having to revamp how they either paid their employees, how the employees maybe needed to become owners of a partnership so that they could deduct expenses there. And it was a big deal. And so having that cliff, but to have that come back in 2026 would have been really difficult because people changed their entire systems. Companies that, big companies changed their systems. Edward Jones had to change their system. They had to come up with a new way of getting to the same place because that tax law changed. So, from our perspective as preparers, it actually kind of makes things easier. But we did have to come up with some ways to work through that. So it is now permanent. They're not these, unreimbursed employee business expenses aren't coming back. That included things, like educator expenses. They've kind of moved that somewhere else. Um, Union dues, it eliminated your accounting fees from that section, and it eliminated your uh, management fees for your financial stuff. So if you were getting charged a management fee by your financial advisor, those used to be able to be in that section. Those are permanently gone. All right. So that's a lot of the stuff that has been made permanent. And that's great because that increases our ability to be able to actually plan. So these things that were supposed to terminate or go away made it very difficult to plan for you. Um, couple of one other small one is that I don't know, a little obscure because unless it impacted you where you actually were moving, you may not have realized that the moving expense deduction that went away, unless you're in the military, and so that is still permanently removed unless it's for military purposes. So, okay, let's move on to some of what is new. This is the stuff that's probably making the news a little bit more. It is the stuff that there's more uncertainty around, I would think. So, first and foremost, I will talk about charitable contributions. So, so something new is they have put what we call an above the line deduction, meaning you don't have to be itemizing to take it, of $1,000 of charitable contributions to anybody who's filing their tax returns. If you donated at least $1,000 or between 0 and 1,000. If you're single, you can take $1,000 above the line donation expense, and you don't have to have itemized to do that. Now, for married filing joint, it's 2,000. And they did a little sampling of this during the pandemic where they had a $300 above the line deduction. Well, they've increased to that. And for me, I say that is a great thing. And that's a great thing because as much as we all want to be charitable, there depending on where you are in your tax situation, you kind of are also looking for tax breaks. And so this should stimulate getting some money into those charities, the charity of your choice, and getting a tax deduction for that. So for the people who are donating smaller amounts, you're not putting it into a donor advised funds, but you do want to go give, to your stray rescue or, somebody's run or somebody's bike ride or whatever that's for charity, you can now keep track of all that and get a deduction. The other piece related to charitable deductions impacts those who itemize. And I'm not as excited about this one. It is new, but it's in the past, it was you got to itemize your charitable deductions um, at at any limit, I should say. So, meaning doesn't matter what your adjusted gross income was, you would start from $1 to be able to start taking that as a deduction. Now they're saying that your charitable contribution base starts at point 0.5, half a percent of your adjusted gross income. So that means if you make $100,000, you wouldn't get any charitable deduction until you gave over $500. And so it's putting this little bit of it's designed for higher income people, but I think it could hurt those middle brackets a little bit. So we'll see how that plays out, but just know that that is coming, and I believe that that is starting in 2025. So, but I will have to double check on that one, on if it's 2025 or 2026. The charitable, I think it's 2025 because the above the line charitable is a 2025 thing. So you still have time to, contribute, up to 1,000, 2,000. And also, um, if you are going to contribute more than that, then that can move over as an itemized deduction. So, so that's the charitable stuff. The other, what is new and is getting a lot of airtime is the no tax on tips, no tax on overtime. So if you've heard of this, this is them saying, okay, beginning in 2025, it's beginning. If you are in a tip industry. So we're talking food and beverage. I think they came back and said health and beauty type stuff. So, your hair, your nails, your aesthetics, anybody who's typically tipped, that there will be a deduction of up to $25,000 per taxpayer for the tips that you have earned. So if you're in a high, kind of want a high tip industry. So you're working in food and beverage. A lot of times your wage is paid less and because you get so much in tips. And so for someone who is full time working in this industry, this is a kind of a boon for them, But it is temporary. It is set to expire in 2028. It has a phase out. So if you make more than $150,000, it will start to, yeah, in for gross income, it will start to phase out, but it will be an above the line deduction for you to reduce your taxable income. Um, Now, for employers, that means they've got to make sure there's going to be changes coming to reporting for W 2s so that when you go to do your tax return, you know exactly what number to pull. And so I know there have been categories for tips on W 2s in the past, but there could be some changes to that. So that could be coming. Now, the no tax on overtime is a whole new ball game. Also set to expire in 2028. It is $12,500 per taxpayer. It is also subject to gross income limits, and it is said to be on the overtime pay. So say you get paid time and a half, you should get an exemption for that extra half, not for the whole uh, time and a half, just the half. If you get paid double time, you should be getting, just the part that doubled, not the whole, not your regular hourly wage plus the overtime. So that brings into a whole lot of kind of a whole lot of craziness because many employers whether if they're tracking it they have to track it inside their payroll system, but that is not a reportable box on a W-2. And so payroll companies are going to have to be jumping through some hoops here before the end of the year to make sure that they've got the reporting correct and it's retroactive. It's not just for overtime that that's been earned since the bill passed. It's overtime for the whole year. So there's going to be some things that are going to have to change in order to get this reported accurately. So um, great, I guess, but it is going to create some administrative payroll nightmare in some respects. So, and on the tips, there's supposed to be guidance coming out on what industries are impacted. So I said food and beverage and health and beauty, but there could be other specific industries. You're supposed to be getting guidance on that by early October. So that should be coming. Um, okay, another new is the enhanced deduction for seniors. So this is the Social Security piece. So so for it's essentially an additional standard deduction. There had been in place, some extra in the past, um, but it was set to phase out, I think, or it was very small. So your standard, if you were over 65 or you were blind, you were getting a little bit of a bump in a standard deduction. So what is happening now is that you're going to add a $6,000 bonus deduction for seniors that is for 2025 through 2028, and then it's going to be gone unless it's extended or somebody makes a change there. Um, and that is also phased out for higher incomes. So for your seniors who are on Social Security, but they also have some investment income and those types of things, then you're looking at having to you're getting an extra $6,000 possibly, depending on what income levels they are at, that will reduce their taxable income. It is not refundable. So it's one of those things that it's not like you're going to um, take this extra deduction and get them into a refund position. It's going to offset the tax. So that is what's happening on the I guess it's referred to as relating to Social Security, but it's really not. It's really an extra standard deduction for people over 65. So, um, another interesting one that they added, which again I think becomes I look at it from what type of document do we get in order to accurately prepare your tax return. And so this one I find interesting. This is going to be that you're going to be able to itemize the deduction for automobile interest if the automobile was purchased in 2025 to 2028 and was assembled in a US based plant. So, and the vehicle has to be the collateral on the loan. Now, think of that logistically. Who's determining where the car was assembled? Who's reporting that so that we know? And now, like we get for mortgage interest, are we now going to have to get the automobile interest that qualifies? I don't know. I don't know. But just so you know, this is going to be added to the interest section of the itemized deductions, I would assume. So in that section, you have mortgage interest, you have some business related interests, and then I obviously will have possibly, if the forms come out the way I think they would, that you would have the U.S. manufactured automobile interest. Okay, now it is limited to $10,000 for car loans from 2025 to 2028. I assume that that is a year, $10,000 of interest in a year. I don't think it's $10,000 of interest total, because that would also be a very hard limit to keep track of over time. So that is also new, and that falls to me in the new and unusual, because I was not expecting that at all. Um, Okay, let me scroll through here. There's, like I said, there's so much. Um, okay, let's talk about what is modified. I think that I would say modification ones would be things like, oh, I don't know, maybe modified is not a great term. There's some obscure things in here that might be modified. Wagering losses is one I would consider what is modified. Essentially, it was wagering losses were limited as an itemized deduction to the amount of winnings. So if you are a gambler, you could only take your losses up to the amount you won, and it was as an itemized deduction. They are now limiting those losses further, and I'm guessing this might be somewhat in response to the fact that gambling is really kind of across the board becoming legal in so many states. All of the apps and all those things, but it is now limited to 90% of the amount of your losses, and only to the extent of your winnings. So that's a modification. So if you're used to always just, turning in enough winnings to offset those losses, you might have to, we have a modification there. Losses are going to be limited. You're going to lose 10% of that as an itemized deduction. Um, and then I would say um, the 529 plans. So 529 plans are really designed for saving money. It used to be specifically for post-secondary education, which would be your college. It has expanded that. The use of the 529 plans, includes K through 12 and homeschool expenses. So you could use a 529 plan to help pay for any type of homeschooling. So if you subscribe to some sort of membership or something that provides you materials as you're teaching at home, that could be a potential use of that. The other thing that it expanded the 529s for is to use the money for post-secondary credentialing. So things like in for my industry, it would be the getting your CPA. There's testing fees, there's course and studying fees, things like review classes, all of those things. So there could be an opportunity that if there's still money in that 529 plan after you've finished college and you're getting some credentialing, that you could use it for that as well. It has been, it's still limited as far as what state deductions you can get, and it's per state. So, but that I thought was new and interesting and a modification. Um, let's see. Okay, so we're gonna hop over to this new one as we're already past 30 minutes here. The salt cap. So for the salt is the state and local tax cap. So with the TCJA, you have a section on your itemized deductions that's for taxes. And in that taxes section, you have taxes you paid to the state, whether it be through withholding, whether it was through estimates. You had your real estate taxes. If you were in a state with personal property taxes, that was in there. Um, and that was pretty, and then local taxes if you live in a city that had local taxes that were withheld. So what the TCJA put into place was that total section, including all of those types of taxes, got limited to $10,000. That's huge. I mean, there are people out there who pay real estate taxes more than $10,000 in a year, and then add in the state taxes, and they got cut off. So their itemized deductions dropped. There was a lot of things there, and so a lot of the business owners who were maybe S corp owners who had a lot of, so they got wages, but then they got limited to how much they could take as itemized. They just really, it became a kind of an issue. So um, the OBBBA actually bumps that cap back to 40,000 or up to 40,000. It used to not be capped at all. So it goes from 10,000 to 40,000. There is phase out for adjusted gross incomes that are greater than 500,000, but even if it's greater than 500,000 and you are in that phase out range, it can't be phased out less than 10,000. So this does open up a range here, the kind of a $30,000 window, which is huge. It's pretty big. I mean, when you're talking itemized deductions, it's pretty big. So this is set to be retroactive for 2025, which means we will get to take advantage of this for 2025 tax planning. As far as when we're estimating what people's itemized deductions were last year, if they were limited, we get to plan for them to get more, which is great. The phase outs are going to be both the 40,000, I think, is adjusted for 1% increase for 2026. No, yes. And then 1% increases for 27 from that 27 and 28 and 29. And then beginning in 2030, the cap goes back to 10,000 unless there's legislation that extends it and or makes it permanent. Now, in response to this limitation that was put in place, many states put in a pass-through entity tax that allowed businesses to essentially estimate what the owner's taxes were going to be, and the businesses could pay that in advance. and the business got the deduction, and therefore the owner was getting less income passed through to them, and that's how they were sort of solving this. And then there would be a tax credit on various states. All the states kind of had not all the states had that, and all the states that did have it did not handle everything exactly the same. So there could be some changes coming with how the states are going to deal with that. But right now, they're allowing, this act is allowing the pass throughs to continue to be unlimited if they are going to continue to have the PTET. So that is the salt cap. I know it impacts several. So if you ever looked at your return and you were itemizing, but suddenly you just see this flat $10,000, like, what the heck is that? I had more than $10,000 in personal property tax and income tax and all these, and I mean, it was crazy. It was one of those big things. It was almost as big for us as the switching the standard deduction up. So it was pretty. That was a massive tax bill. I will admit to you, when I sat through the tax training class that year, I remember sitting there, and I can't remember, somebody on my team was sitting next to me, and I'm like, I think I'm going to retire. It was so massive. But here we are, several years later, and I am still doing this. And I think for the most part, we've got some good things coming. There's some tax cliffs that have been eliminated, and we are have a clearer picture on how to make plans. And that's what we want to do. We want to help our people know what's coming. We don't like surprises. And so tax laws that we don't know what is going on make us crazy. So my advice for what to do next is to first, you're going to want to chat with your tax preparer this year. If they don't send something out regarding these changes, or you don't see anything from them, you're going to want to reach out and say, hey, what will this potentially change? But please, 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 I would suggest wait. Give give the bill some time. Give the IRS some time to actually get some guidance written. So right now we are all interpreting that language that's in this this 800 pages of text. We are still having to do a lot of interpretation. And what happens with these bills is guidance will come out. The IRS will publish guidance in some form and then they will also change the forms. So all of the forms that will be changing or added or any of those things, um, it's happening. So we want you to get information, check in with your tax preparer, but give us time. So I would say planning this year, you're not going to start it until later in October. And that does push it a little bit. However, you do want to have that conversation before the end of the year. Once December 31st has passed, there isn't anything you can do to change things. It's now history. So there are a lot of hard and fast deadlines relating to year end. Now, there are a handful of things, relating to putting money into your IRA or, various other things, but that can be done during the tax season. But you want to check in before then. And then the other thing that is going to happen, and probably, I don't know that they've formally announced it, but the filing season is probably going to be pushed back as far as when it's going to open. Meaning, typically, we are able to start e-filing individual tax returns by the end of January. And now we're probably looking at probably closer to mid-February before we can start e-filing. That doesn't mean that we aren't going to start preparing returns. It just means that we can't do the submission until mid-February, as we're waiting for all of the software vendors, the IRS's systems, all those systems have to be updated. And so it takes a while. It takes a while. But we are lucky that they passed this bill in July and not in October or November. And I will say that though they are going to extend when they will probably open the season, they're not going to extend the April 15th deadline, the March 15th deadline for businesses. So that means our tax season is going to be compressed. And as I say that, and I say, okay, so make sure that you're not dragging your feet this year. So as you're getting the information, you think you have all of the information, even if we can't get it filed until later in February, get it to us because we are going to have a little bit of a compressed season. Um, by them not opening it till the middle of February, that only gives us a couple months to get all the individuals done. So, okay, if you have any questions, leave them in the comments. If you're watching this on the replay, leave it in the comments and we will get back to you. If there's anything that I didn't cover and you want to hear about, leave me a note. I'd love to hear from you. And as always, if you need me, you know where to find me. But also, uh, if you have tax questions, concerns, issues, reach out to your tax preparer. If I'm that person, let's wait until October so that we have more guidance. But otherwise, um, don't be afraid of this bill. Get your information from reputable sources. Fact check me, in fact. I mean, it's like I said, we are working off of summaries from reliable sources. But again, everybody makes mistakes. So please, please, please let me know if you have any questions. All right, everybody, have a great day. I'll talk to you next time.